Hello, everyone. Welcome to the Brainless Investor YouTube channel. Today's topic is simple and compounded interest rate. So what's an interest rate? An interest rate is the rate of percentage charged for borrowing money. Example, lender to borrow or earn it on saving financial institution or depositor. So borrowing money, the interest rate is what the lender charges you for using their money. Savings or investing. The interest rate is what the bank or institution will pay you for keeping your money with them. So there's two types of interest rate, which is fixed interest rate stays the same over time, or variable or floating interest rates that changes over time to time based on market condition. However, today's video, we will focus on fixed interest rate. There are five factors that influence interest rate. The first one is central bank policy, inflation, economic growth, supply and demand for credit, and risk. Central bank policy. They set a benchmark rates that influence all other interest rates. If the inflation is high, they raise rates to slow down spending. If the economy is low, they lower down rates to encourage borrowing. Inflations. Higher inflation usually leads to higher interest rates to preserve money's value. Economic growth. Fast growth can increase the rates to cool down the economy. Supply and demand for credit. More people borrowing equals to higher rates. More people saving equals to lower rates because bankers do not need to attract people to deposit more. And lastly, risk. Higher risk borrower, like with bad credit, are charged with higher rates. Let's look at the first fixed interest rate, which is simple interest rates. Simple interest rate is calculated on the principal or original amount of a loan. The principal is always the same. Simple interest is calculated by multiplying the loan principal by the interest rate and then by the term of the loan. It has a linear growth rate. So the calculation is equals to P times R times T, whereas P is the principal, the initial amount, R is the interest rate in decimal. So for example, 5% equals to 0.05, and time is in years. The second fixed interest rate is compound interest rate. Compound interest rate is the interest calculated on the principal and the interest accumulated over the previous period. The interest multiplies savings or debt at an accelerated rate. Compound interest is calculated on both the initial principal and all of the previously accumulated interest. It has an exponential growth. Calculation for compound interest rate is P times 1 bracket 1 plus R over N bracket powered by N times T, whereas P is principal, R is the annual interest rate in decimal again, so 5% equals to 0.05, N is the number of interest compounded per year, T is time in years again. So let's compare between simple interest rates and compounded interest rates earnings. We'll take an example of a principal value of $8,000, 7% of annual interest, 10 years in times, and number of compounded interest in a year is 1. So simple interest rates, you'll take 8,000 times 0.07 times 10, so you'll get 5,600. So in 10 years, you'll earn 5,600 in interest. So compounded interest rate, after inserting the formula, you get 8,000 times 1.97, so minus off 8,000 again. So in 10 years, you'll earn $7,760 in interest. So the difference between compounded interest rate and simple interest rates earning is $3,160. So which one is better? Really depends if you're investing or taking out loans. If you're taking out loans, you'll pay less taking the simple interest rate. If you want to make investment, then you'll earn more by taking the compounded interest rates. We hope you enjoyed our video today on simple and compounded interest rates. If you enjoyed it, please leave a thumbs up and subscribe to our YouTube channel.